Investing isn't risky. Being financially uneducated is risky. In this video, I will show you different risks in the stock market and how you can educate yourself to control those risks. What's going on, guys? Welcome to the episode 3 of Investing in the Stock Market for Beginners series. If you have missed the first 2 episodes, you can find a playlist in the description. Click the subscribe button so you don't miss the future episodes. Let's get started with risks and diversification, starting with different risks in the stock market. Number 1. Going all in. The golden rule of investing is to never invest more than you are willing to lose. Warren Buffett says that risk comes from not knowing what you are doing. I agree, but the number 1 mistake you can do is to be too confident in yourself. When you are just starting to invest, diversify to different companies. You don't want to go all in with one company just to notice that you picked the wrong company and you have now lost everything. It is not unusual in the stock market that a company can lose 50% of its value, so if you own just that one company, you lose your money. Even if you research a lot and choose to buy just one company, there can be many risks that make the price of the stock crash that you can't predict. For example, one bank got involved in money laundering. Imagine the headlines when media finds out about that. This company's shares lost over 20% of value in just a couple days. Investing in index funds or buying shares from many different companies lowers the risk of losing everything, but more about that later in this video. Don't put all your eggs into one basket. Number 2. Timing. Making money in the stock market is easy, just buy low and sell high. Then enjoy your life in your new mansion with your 5 Lamborghinis. The only problem is that timing is not easy to do when prices change all the time. Just when you think you are buying low and go all in, you notice that the price just keeps going down for the next week or even months. To buy low and sell high, you would have to know when the stock stops crashing, plus you would have to know when the stock is about to start rising before everybody else knows that and starts to buy the stock. Probably not impossible, but very difficult to say the least. Number 3. Economic risk. Economic risk is one of the most obvious ones. When the economy crashes, the prices of stocks crash. For example, this chart shows Dow Jones Industrial Average from 2003 to 2009. As you can see, the index slowly climbed for 5 years and then boom, 2008 just arrived with its financial crisis and we are back where we started in 2003. When the economy crashes, it might be a good time to buy more stocks. Don't just buy any random stock though, buy good businesses that generate profits and are stable and can continue operating even during crises. Number 4. Inflationary risk. These days the government controls inflation pretty well. Many countries have an inflation target, usually the target is around 2% a year. Let's say you invest $10,000 to a 10-year bond with 10% annual interest. This means that every year you get $1,000. But in fact it will be worth less every year. The first year your profits will be worth $1,000. Next year with 2% inflation the value is only $980. The third year the value will be $960.4, and in 10 years your $1,000 are only worth $817. This means that you have less purchasing power after 10 years than what you had in the first year. Number 5. Currency risk. Last risk I mentioned is currency risk. When you invest in a foreign currency, for example if you live in the US and invest to a European stock, if the exchange rate between US dollars and euros change, this can affect your earnings drastically too. If you own a European stock that gives you a 10% return, but the euro depreciates 10% against the US dollar, you didn't make any profits, you just break even. So those are the risks that I want to mention. One statistical measure for risk is volatility. It shows how much the stock's value can spread potentially. This means that the price of the stock can change dramatically up or down in a short time period. The higher the volatility, the more dramatic the changes can be. For example, this stock crashed at 43% in one day and then later it rocketed 62%. So this stock has a very high volatility, so we can say it is a very risky stock too. Steady companies like Coca-Cola and Berkshire Hathaway are a good example of low volatility. The prices don't crash or rocket suddenly, they are very steady. One ratio to look at is the beta of the company. The higher the beta is, the more volatility there is. When beta is 1, the stock price will move with the market. If the market moves 10%, the stock will move 10%. If beta is less than 1, volatility is low, and if it's higher than 1, volatility is high. For example, this company's beta is only 0.48, which is very low. For this company, the beta is 2.21, which is very high. The website shown in this video is investing.com, link can be found in the description if you are interested. So now that we know the different risks, let's move on to diversification. Don't put all your eggs in one basket is the simplest way to explain diversification. If you drop your basket, all the eggs will break. But if you put each egg to a different basket, dropping one basket won't break all your eggs. There is more chance that you will break one egg, but less risk of breaking all the eggs. So in the stock market, instead of eggs, you buy different stocks. You could also invest in other asset classes like real estate and gold, for example. So like with the eggs, if your investment portfolio has 20 different stocks in it, you have a less risk that all of them will crash. Diversification also lowers your return on investment when some companies are rising in price, others are falling. So with diversifying, you won't make the best possible returns, but you won't make the worst either. So how many stocks should you buy? Studies have shown that the most cost-effective diversification portfolio comes from owning 25 to 30 stocks. But you could start with as low as 10 or even less. It's really about how much you have studied the companies that you can carefully choose the right ones. The problem with owning 30 stocks is that if you are not a full-time investor, it is impossible to study and research 30 companies to know which ones to buy. Because of this, you could invest in index funds. I personally prefer index funds over mutual funds because they are more cost-effective. So what are index funds? Index funds are usually automatically managed, and because of that they have lower costs. Some brokers even offer them cost-free. Index funds invest in many different companies. For example, S&P 500 invests to the top 500 US market value companies. This means that when you invest in S&P 500, you are investing in 500 different companies at the same time. So if one goes down, you won't lose your money. In fact, when one goes down, it will probably make the others go up. Index funds are a great way to lower your risk, but with this comes the fact that your profits won't be better than the average market profits. Another great thing about index funds is that you can start investing with just a couple dollars. So even if you don't have much money laying around, you can start slowly building your asset column. While index funds are a great way to diversify, there are other factors that you should also consider when diversifying, like time, sector, location, and asset class. For example, you could buy stocks every month to diversify in time. Index funds obviously invest in different sectors, but if you choose stocks by yourself, choose them from different sectors like information technology, financials, or energy, for example. For location, you could buy stocks from all around the world, like from Europe, Asia, and the US. And lastly, you can invest in different asset classes like stocks, real estate, bonds, and so on. So that's it about diversification. It is an easy way to lower your investing risk. I know that many wealthy investors say that diversification is for idiots, but as a beginner, I think you should diversify before you understand better how investing works. Remember, investing isn't risky, being financially uneducated is risky. If you want to know more what Robert Kiyosaki thinks about investing, check out my recent video for a book summary of his book, The Cashflow Quadrant. Let's quickly summarize the video. I mentioned 5 different risks in the stock market. Number 1 was to never go all in. Don't go all in with one company unless you really know what you are doing. Number 2 was timing. When you think the price is low, it can still drop for months. To buy low and sell high, you would have to know when the stock stops crashing and buy it before everyone else buys it. Number 3 was economic risk. When the economy crashes, the price of the stocks crashes. Number 4 was inflationary risk. Inflation is around 2% each year. This affects your profits in the long run. And last risk, number 5, was currency risk. When you invest in a foreign stock, a change in the exchange rate affects your profits too. Volatility is a statistical measure for risk. The higher the volatility, the more risk there is. You should look at the company's beta ratio to know the volatility. And lastly, diversification is a great way to lower the risk. Don't put all your eggs in one basket. While it lowers the risk, it also lowers the return on investment. Simple way to diversify cost efficiently is index funds. With index funds, your return will be average market return. Thank you for watching the episode 3 of Investing in the Stock Market for Beginners series. Next week's episode will be about financial ratios, don't miss it by subscribing. If you are also interested in cryptocurrencies, make sure to check out my Cryptocurrency for Dummies series that I just started. Have a nice day, and I'll see you in the next video.